Hello everyone and welcome to Think Wealth TV. There's been a lot of changes in the portfolio this week that we're going to go over, but in this channel, just so everybody knows, we go deep. Meaning there's a lot of details we put in this video, full transparency. So we try to make our videos, especially educational ones, very detailed so you don't have to watch multiple videos to get all the information you need and get all of them in one video. We also try to simplify it where we can, such as the thumbnails. The thumbnails are color coded, blue meaning educational, green are updates in the portfolio for the week, or also a list of our portfolio holdings and details, or how much we made in premiums and dividends for the month. If you guys like this kind of content, you guys enjoy all the information, please like, that's the biggest thing you can do to help out the channel, and subscribe and hit the notification bell. Let's jump in. All right, we had a fairly big change inside our HSA account for the week. The first thing we had for the week is we had $2.89 in Wells Fargo. That's for a CD I have with them for $2,000, earning 1.7% interest. But the big change that we had is we sold SCHD. If we click on here, we had 40 shares of SCHD. We sold them for $56.37, and they charged me 5 cents for a fee to sell them. What we did is with the cash, that was $2,254.75. We bought 30 shares of VYM at $82.65. As you guys look on the screen, on the left side is SCHD, and on the right side we have VYM. First, there's nothing wrong with SCHD, okay? There's actually a great ETF. That's why I bought it in the first place. But I think VYM is better, at least for me, starting with the sector allocation. If we look at each one of these, we have the sectors over here for SCHD. Then for VYM, we have the sectors over here. If we compare them, we have both financials is the number one for each one of them. But SCHD is at 23.94, so basically 24%. And then VYM is 18.7. So as you can see, VYM has less exposure to financials. I have nothing against financials, but there's just a little bit less there. Number two for SCHD is industrials. For VYM, it's healthcare. I like both, but healthcare is at 16% versus industrials at 19%. As you can see, it's looking a little bit more balanced. When you go to consumer defense, you have 17.2 versus 15.49. Technology for SCHD, 13.58 versus 10.54 VYM. As you can see, they're just more balanced. Like VYM, if you look for utilities, is at 9.19. If you go over to SCHD, it's at 0.01. So there's no utility exposure and there's no REIT exposure. There's basically no REIT when it comes to VYM, but everything else there's exposure to. I like that it's more balanced with the VYM. SCHD is a little bit more heavy in certain industries. It's not as well balanced. So that's the main reason I switched. Another thing that's worth considering, it's not a deal breaker per se, but on the left we still have SCHD and on the right we still have VYM. SCHD has 104 different holdings. That's the number of stocks inside the ETF. And if you look at VYM, you have 430 different holdings. So basically it has technically over 4 times the amount of stocks inside a portfolio. So there's a lot more diversification. That's not a huge deal. 104 is not bad, but that is another plus going for VYM on top of the balanced sector allocation. Another reason why I switched, it isn't a big concern, but if you look at the dividend yield on each one, SCHD has 3.27% for the yield. VYM has 3.58%. So VYM does actually have a little bit of higher yield. I am primarily a dividend investor, but that being said, I'm here to make money, meaning I'm not going to stick to only one specific investing style and not do any kind of other types of investing as in growth or anything else and limit myself to only dividends. There's a lot of money to be made on Wall Street, and I plan on getting a hold of it. Now, 5-year growth rate for SCHD is 10.49, VYM 8.29. That's not a huge difference for me, and in my personal opinion, you don't know how long they're going to be able to keep that up, you know. It might be 10.49, but 5 years from now, it might be significantly lower. 5 years from now, this 8.29 could be higher, but they're fairly close. The dividend growth, 8 years for this, 10 years for that, so VYM looks a little bit better there, but not a big deal when it comes to that. The last reason why I switched primarily was a sector diversification, which if you guys haven't seen, I do have a great video on that you guys could watch that's already out. Very detailed, a lot of information about diversification. But if we look at the 1 years on both, SCHD is plus 6.38%, VYM is down 4%. I believe personally it's due to the sector allocation. Utilities isn't doing that good, and SCHD doesn't really have any utility exposure. SCHD has more allocation when it comes to technology. So in theory, they should do better. Now, I do believe that things change with time, especially in the stock market. So technology is doing great right now. Doesn't mean it's always going to be doing great. Some people believe it will. In 2000, everybody believed it'd do great. And the dot-com bomb changed that theory altogether. But as I said before, I do invest primarily in dividends, but there is more growth potential with VYM. As you see, it's still down 4% versus SCHD, which is up 6%. Just because an ETF is down doesn't mean it's a bad ETF. That's what I see a lot, whether they're YouTubers or investors that will bash an ETF because it's down, but they don't take into consideration allocation. Yes, if you look at the NASDAQ ETF, that's going to be substantially higher than, let's say, SPHD, which has a lot of real estate exposure. So I think it's very important to compare apples to apples. SCHD, no utility exposure, more technology exposure. Utilities aren't doing terrible, but they're definitely not doing great, that's for sure. And then VYM has more balanced sector allocation. They have less exposure to technology and have a lot more exposure when it comes to utilities. It's almost 10% versus SCHD, which has 0% basically. Inside the very small individual account at Fidelity, we have 136.60. If you guys aren't aware, this money was completely free from my Fidelity credit card. So it's only 136.60, but none of this is my own money. Go to activities for the week. We can see again that what happened is I bought $10.06 of SPHD shares. So more partial shares that bought me 0.296 at $34. And then we did the same thing where we sold SCHD and we bought 1 share of VYM. So same thing as HSA. We sold SCHD, we bought VYM. When it comes to balances now, there is 3 cents in there. Inside our Roth IRA, I call it the Grand Retirement Account, there is no activity for the week. We're just sitting at 21,421, 32 cents. So if we look over activities, it's to show you guys the week started at 8/17. We don't have any history, no activity, I should say, for the week. And then balances, we're still sitting at 98.48. Inside the M1 Finance portfolio, same story. There wasn't really any activity. Before the market opened on Monday, there was 6,000 in here, so we are down. But everything's been down this week, so it's been kind of a red week. If we go into activities, there's nothing but Avi was on the 14th, 23.99. Now, when I made my video last week detailing all my holdings inside my portfolios, I recorded on a Friday, and this dividend didn't actually show up until Saturday. So if you didn't see it in that video, that's why. They pay the dividend supposedly on Friday, but you don't receive it with M1 until Saturday. Inside the Robinhood portfolio, we have had a lot of changes for the week. We are down also for the week, unfortunately, basically $700, $699.98. Inside the options section, we did have this Friday a contract for Haynes, a covered call, was exercised in the amount of $15 a share. Now, I've been keeping track of my Haynes cost basis, and with all of the calls I've done, all the puts I've done, dividends, and capital appreciation, I'm up $432.08, and I do have a $15 dividend coming on the 1st, so that'll put us at $447.08. So to me, that's pretty good. I started doing the contracts, I believe, in like February, so make it $432, basically, well, $447 once I get that dividend is pretty good for me. Now, for the options that we have currently still, we still have the T put, that's the same. We still have the PBC T put. If either one of those go down to $5, I will basically buy them back. And then we did sell a Wells Fargo put for $95. And I think we had the Exxon last video, not sure. But that one I sold for $104. and the BP sold for $98. They are down in a sense. I plan on holding on to them. If they get exercised, they get exercised. I could always roll them out a couple weeks if I wanted to push them out farther. But I'm okay if they get filled. If they do, Wells Fargo and BP, I will most definitely be using a wheel strategy and start selling covered calls for those. I'm not married to those stocks. ExxonMobil, that one I'm not sure what I'm going to do with. I do like that stock. I don't want to hold it for the long term unless something changes in the oil industry, which I doubt. But in the short to medium term, I think I can definitely make some good money. Exxon, I believe, will go up to $60 a share. If it hits that price, I will sell at least half my position, if not more. But with these 100 shares, if I did get them, I might do the wheel strategy. I'm not sure. If we scroll down to stocks, we did have a couple new changes. PBCT, we had 50 shares. We bought 50 more at $10.45. So I've been tracking that too. And the cost basis for my PBCT shares with selling the puts and with the dividends, haven't done any swing trades with them. But as of right now, my cost basis is at $9.30, $9.60 for the shares. So to me, that's amazing. And then we did pick up the other 20 shares of Wells Fargo. Considering selling Seagate, I do like Seagate, the company. I was looking at their dividend history recently, and somehow I missed this. But it looks like they paid a dividend in 2009, the beginning. But then they suspended the dividend until 2011. So everything looks fine. Their dividend looks okay right now. But there's other companies where their dividend looked fine and they still managed to cut it anyways or suspend it. So I'm a little concerned about them. So I might actually sell out of them. My average price is $44.75. So I'm up still right now. I'll probably wait for a green day and to sell that one, so get a little bit extra profit. Okay, if we jump into our history for the week, there's the Avi. I didn't mention it in the last video because I was recording a video Friday night, and I believe Saturday, a little after midnight, we received the dividend for Avi. PBCT, we got the dividend from them. I messed around trying to get certain prices, strike prices on contracts, on different puts I was selling. And those are those canceled ones if you see them. And then there's a Wells Fargo 95, BP 98. We talked about there. There was the 20 shares about a Wells Fargo. And then you have Altria Group. I did a contract there for, I believe it was like $98 for Altria. And I bought it back for $57. So I picked up $41. Then we have the Haynes. See, that was assigned. I got $14.99.95. So I'm guessing Robinhood charged me like 5 cents fee for assigning that call. Those are the 50 shares of PBCT I bought. I messed up on a contract. I was doing something around the house and I didn't realize that I ended up selling the contract for $50 to get it back for $15. And then I ended up buying it back right away for $54. So I ended up losing $4. And I put that on my cost basis for Haynes. So even with losing the $4, I'm still up that $432.08, not including that $15 dividend that's coming in. And then these are some of the pending ones we have. We have the BTI still coming in this month. And starting next month, we got the Haynes, Wells Fargo, Southern Companies, CVX, Exxon, which CVX is Chevron, IBM, Duke, Shell, and BP. I believe we also got PEG. That's PEG Utility still. We'll be paying us this next month as well. All right, we're inside the portfolio tracker. And if we start from the left and work our way over, there's ticker, company logo, company name, share price currently, number of shares I own. Right now, Haynes is at 0 because I ended up selling 100 shares with a covered call. And then we have dividend yield. We have the annual dividend, what they pay, and then the market value for the amount of shares I own, and how much they produce annually on an income basis for the amount of shares that I own, and how much of my portfolio is allocated to specific stock. Right here is sectors. So I have them labeled in sectors, and that's how they're actually organized. And there's 46 different stocks that I own, and they're listed down here. And as you can see, there's quite a bit. The ETFs that I own are right here. We got SCHD, VYM, and VOO. My 457K, there's 33,259.58. Now I do plan on withdrawing $9,000 to $10,000 next year. That could change, but as of right now, that's the plan. We have $2,000 in CDs, and this is in the brokerage accounts, all of this information. And then we also have cash, $1,624.44. So that brings everything cash, all the different holdings, ETFs, CDs, inside the brokerage accounts, inside the portfolios together. It's $101,117.16. So we are down because of this whole week's been down, unfortunately. I do use a little bit of margin. I have $2,177.69. I don't suggest people use leverage, but me personally, I take advantage of everything. I do have cash not inside this portfolio that I can use to pay off this margin if I need to. It's 5% interest through Robinhood, and I'm making off the stocks I bought somewhere between probably 6 and 7% just off the margin itself. So I'm making on the leverage part of it, if you think about it, like as in leverage, I'm making 1 to 2% off of that 5%. So if I'm making 67%, you minus the 5%, I'm netting 1 to 2%. And then my cash that's sitting in accounts is averaging somewhere around 2%. So altogether 3 to 4%. Yes, I could pay it off, but that's just what I'm doing right now. This is what it'd be after margin. So if I needed to withdraw money, I could withdraw this amount. My stocks annually are making me $3,053.31. At least that's what the projection is per year to make as of right now. As we get raises, that'll change. It's very important, and if you're serious about investing, to be tracking your portfolio. It shows a lot of where your stuff's at, how much you have in each sector. As I scroll down here, we have our portfolio allocation. As you can see, 32.9% of my funds is in that 457K. So as we start pulling money out, that's going to start shrinking that amount, and that's going to significantly raise my dividends, because I'm sure in my 457K it's making some type of dividend, but it's most likely just being reinvested. They don't tell me. It just the amount goes up. So I don't know how much dividends I'm getting. They're all in basically an S&P 500 index, so right now, off the top of my head, I'm just guessing maybe it's 1.8%. They're not a realized gain because they're in that 457K, so I can't utilize it as what I deem best. But as you can see, my holdings for the most part are pretty equal. I mean, there's of course some that are bigger than others. AT&T, 6.8%. That's a pretty large holding. I don't mind it being that high, but I do like the more the 2-3%. Heavy's up to almost 4%, and then you have Altria about 3.2. But a lot of them, the VU's at 3.1. They're not that big of positions. They're spread out pretty nicely, I think. So this is another neat tool, is it shows you if you have really large positions, how well your stocks are split up, which is nice. And then over here, this is where a lot of the information is pulled from this box to the right. And then if we scroll down, we also have these. A lot of these are eye-opening if you haven't started tracking your stuff. Like, I didn't realize really how much I was getting in cash and cash equivalents. So I have outside of the brokerage account, this is where the 28.2% is coming. So not in the brokerage, outside of the brokerage accounts, there is basically things I have in high interest savings, CDs, money markets. They're making me about 28.2% a year, or $1,200 a year. It's actually making me a little more. I like to, on certain things like that, that's not tracked as well as the dividend stocks are, because as the banks lower interest rates, the interest I'm earning is changing. So I try to estimate it a little bit on the low side, so it's a little bit more than $1,200 a year. But yeah, it still shows you that 28.2% of my income comes from cash equivalents, which is a little bit high. I don't like it being that big at all, to be honest. But me and my wife, we do real estate, and we need to have some cash available, so we have to keep a decent chunk right now. So to change this, I'd like to have more money in stocks. So this, even if this stays the same amount, it'll become smaller and smaller as these become larger and larger. Consumer discretionary, that's kind of low. Consumer staples, 13.8. That seems pretty good. Energy's 8.9. You have financials, healthcare, and you have all these different sectors all listed how much I'm making off of them. And telecom's making 12%. No surprise there when you have AT&T. If you scroll over here, you can see if it tells a different story. I try to keep them somewhat balanced. So as we can see over here in sector allocation, we have a pretty big sector in ETFs, 12.1. That's probably going to grow some. That's to somewhat be expected When SCHD gets out of my HSA, I'll probably buy some more ETFs, or might actually buy some bonds. I'm not sure. And then we have consumer discretionary. Consumer staples is a pretty big for sector allocation. I'm okay with that. The only thing I don't like is I do have too much tobacco exposure. I would like to have that smaller, but I'm going to wait for those to recover before any tobacco is sold, if I do sell them. Energy will most likely be sold, probably cut in half the position once they recover. And then financials, I wouldn't mind growing that, but that'll probably get cut as well once they grow. So I wouldn't mind growing financials at 10%. Then once everything fully recovers, sell half my positions, and basically I'd be down to 5%. But if the stocks double, in a sense, that 5% is free. I talked about in my detailed portfolio allocation what I plan on doing with Wells Fargo to basically get 20 shares for free. But we have healthcare 12.1, industrials 4%. We have materials is kind of low, that needs to increase. I wouldn't mind increasing industrials 5%. REITs, I'd like that at 10%, especially when they're low. REITs is a sector I believe that's ideal to buy at the right time. So right now with REITs being down, I should probably be getting more money in REITs, get that up to 10%. Technology is 5.1. I'd love to get that bigger, but I need to find a technology company that's not overvalued significantly. If you guys know any technology companies that are not extremely overvalued, that's actually a good deal, that pays a decent dividend, has a good track record, decent financials, things like that, it doesn't have to be perfect, leave it in the comments below. That'd be nice to know. Telecom's 15.5%. Yeah, that's a little bit big, but I'm not too concerned about it, but it is a little bit big. Utilities 4.2. I wouldn't mind growing it to 5% as well. But overall, I'm fairly happy with my allocation. I would like things a little bit different, but I'm fairly happy with them. I hope you guys enjoyed the video. If you guys did, we're going to be having more videos on various topics coming up shortly, as well as continually giving you portfolio updates. Please like and subscribe.